He earned $180,000 a year. His mortgage was denied. His credit score was 621. He had no idea why. Before we get to Kevin's story, a quick question. If someone offered you a job paying $180,000 a year, would you expect to have good credit? Most people would say yes. High income means financial strength. Financial strength means good credit. That is logical. It is also wrong. And understanding why it is wrong is one of the most useful things you will ever learn about how money actually works in America. Part 1. Kevin. Kevin Morris is 38 years old, petroleum engineer, $180,000 a year. He had been renting for 10 years, finally decided it was time to buy a house. He walked into a bank in March 2020 with confidence. He had the income. He had the job stability. He had the down payment saved. The loan officer ran his credit, came back with a number. 621. That is too low for our standard mortgage products. Kevin stared at the number. I earn $180,000 a year. How is my credit score 621? The loan officer explained. Kevin nodded along but did not fully understand. Nobody had ever sat him down and explained the difference between earning money and having credit. He left without the mortgage. Here is what Kevin did not know. When a bank looks at your application, it is not asking one question. It is asking three, and your income only answers the first one. The second and third questions are what decide whether you get approved. Part 2. The three questions. Question 1. How much do you earn? This is your income, your salary, what comes in each month. Kevin earns $180,000 a year, $15,000 a month. Question 1 answered easily. Question 2. How much do you already owe compared to what you earn? This is called your debt-to-income ratio, DTI for short. Here is the plain version. Imagine you earn $5,000 a month. You already pay $2,000 a month on existing loans and credit cards. That is 40% of your income already promised to someone else before you even pay rent or buy groceries. A new mortgage would add even more. The bank gets nervous. DTI, debt-to-income ratio, adds up all your monthly debt payments and divides by your monthly income before taxes. If you pay $2,000 a month in debts and earn $5,000 a month, your DTI is 40%. Most mortgage lenders want your DTI below 43%. Below 36% is better. Question 3. Have you proved over time that you actually pay things back? This is your credit history. Not how much you earn, not what you owe right now, your track record. Have you had credit accounts? Did you pay them on time? For how long? This is where your credit score comes from. High income does not create a credit history. Only time and consistent behavior creates a credit history. Kevin had a strong answer to question 1. His answers to questions 2 and 3 are what hurt him. Before we see exactly what was in Kevin's file, there is something about question 3 that almost nobody explains. We will come back to it. Part 3. What was in Kevin's file? Kevin earns $180,000. That is clear, but here is everything else. Student loans, 6 years of engineering school. Outstanding balance, $95,000. Monthly payment, $1,100. 2 car loans, one for him, one for his wife. Combined monthly payments, $1,400. Credit cards, 4 cards. Combined limit, $20,000. He used them regularly for work travel and expenses. Current combined balance, $16,500. That is 82% of his available credit being used. Utilization, how much of your available credit you are using, is one of the biggest factors in your credit score. $16,500 out of $20,000 available is 82%. High utilization tells the bank you are financially stretched, even if your income is high. We covered this fully other video. Kevin's total monthly debt payments, $2,995. $15,000 monthly income, $2,995 in debt payments. DTI, just under 20%. Actually fine, so that was not the main problem. The main problem was question 3. Here is what was missing. Part 4, the thin file problem. Kevin grew up in a family with one rule about money. If you cannot pay cash, you cannot afford it. His parents distrusted credit, never used it. Kevin followed the same rule until his late 20s. He got his first credit card at age 29. His student loans and car loans were only a few years old. He had never had a mortgage. He had never had a personal loan. He had 4 credit cards, all opened in the last 3 years. His credit file existed, but it was thin. A thin credit file means there is not enough history in your report for the bank's model to be confident about your future behavior. Think of it this way. A bank is deciding whether to lend you $300,000. They want evidence. The more evidence they have, years of consistent payments across different types of accounts, the more confident they are. Kevin had 3 years of evidence. The bank wanted more. Thin credit is treated similarly to bad credit, not because you are risky, but because the model does not have enough data to know. Now here's the part nobody explains. Kevin avoided credit his whole life because he thought it was the responsible thing to do. He saved instead of borrowing. He paid cash instead of using cards. By conventional wisdom, he was doing everything right. But the credit system does not reward saving. It rewards borrowing and paying back. Kevin had done a lot of saving, very little documented borrowing and paying back. To the credit model, he was almost invisible. An invisible borrower gets treated like a risky borrower. That is how a $180,000 income produces a 621 credit score. And the 82% utilization made it worse. Even with high income, the model read high utilization as financial pressure. Add a short history plus high utilization, and the score lands at 621. Part 5. The simple comparison that explains everything. Here are 2 people. Person A earns $50,000 a year. 1 credit card, used occasionally, paid off every month. 1 car loan, paid on time for 4 years. No other debt. Credit score, 740. DTI, 8%. Person B earns $200,000 a year. 6 credit cards, most nearly maxed out. A car loan and a boat loan. Missed 2 payments last year. Credit score, 620. DTI, 45%. The bank will lend more comfortably to person A, not because they earn more, because the bank's real question is not, how much do you earn? The real question is, will you pay us back? Person A's file says, yes, consistently, for years. Person B's file says, maybe, but there are warning signs. Income is not evidence of repayment behavior. History is. Part 6. Calculate your own DTI right now. Most people have never calculated their DTI. Here is how to do it. Step 1. Write down every monthly debt payment you make. Car loans, student loans, personal loans, mortgage if you have one, credit card minimum payments, not what you pay each month, the minimum required payment. Do not include rent, utilities, groceries, or subscriptions. Only loan and credit card payments. Step 2. Find your monthly income before taxes. Take your yearly salary and divide by 12. Step 3. Divide. Monthly debt payments divided by monthly income. Multiply by 100. That is your DTI percentage. What it means. Below 20%, healthy, most lenders happy. 20% to 35%, fine, most mortgages approved. 36% to 43%, getting tight. Above 43%, most mortgage lenders will say no. Do this calculation now if you can. The number you get tells you more about your borrowing situation than your salary does. Part 7. What Kevin actually did. Kevin did not need a pay rise. He needed to change what the bank could see. 4 things. 6 months. 1. Pay down the credit cards. His utilization was 82%. That was the most visible problem. He paid $10,000 off his balances over 4 months using money he already had. Utilization dropped to 28%. Utilization resets every month. There is no memory. The score improved quickly. 2. Stop applying for new credit. He had opened 2 new cards in the previous year. Each application left a mark on his file, called a hard inquiry. Multiple recent applications suggest financial desperation to the model. He stopped applying for anything. Hard inquiry marks fade after 12 months. 3. Keep old accounts open. His instinct was to close the cards he was not using. That would have been a mistake. Closing cards reduces your total available credit, which pushes utilization up even if your balances stay the same. He kept them open, used one occasionally, paid it off immediately. 4. Let time pass. There is no shortcut to a longer credit history. Every month of clean payments adds evidence to the file. Kevin waited 6 months after making his changes before reapplying. The result? 6 months later, credit score 689. Still not perfect, but enough. Mortgage approved. Final act. Kevin moved in February 2021. At the second application, the same loan officer handled his file. Kevin asked, "Why did nobody explain this to me the first time?" The officer paused. "Most people assume income is enough. We see it all the time. Doctors, lawyers, engineers, high salary, low credit score. Same reason every time." What reason? They built their income. They never built their credit history. The bank does not care how much you earn. It cares how much you owe compared to what you earn. It cares whether you have proved, over time, that you pay things back. And it cares how much of your available credit you are using right now. Those are 3 different things. Most people only ever think about the first one. Now you know all 3, and you know how to improve each one. 3 things this week. 1. Calculate your DTI, monthly debt payments divided by monthly income. If it is above 36%, that is the first number to work on. 2. Check your credit utilization. If it is above 30% across your cards, pay it down before your next statement closing date. 3. If you have been avoiding credit your whole life, that is not protecting your score. It is leaving it empty. Start small. 1 card, use it occasionally, pay it off. Build the record. Kevin did not need to earn more. He needed to understand the right numbers. Now you do.